Stocks turning red here. Let's talk some earnings. We do have some action in the consumer staples category with a down day, maybe a group to watch if we are going to sell off. Tom's here with me looking at options, and Arun Sundaram back with us from CFRA, equity research analyst and staple of our own lineup. Arun, let's talk some spices first here. McCormick, what do we learn?
Yeah. Hey, Oliver. Yeah. So from a headline, it looked like a soft quarter. There was a sales miss and an EPS miss. But if you really dig down into the results, the sales miss was really due to foreign currency headwinds. In fact, organic sales, which excludes foreign currency, grew 2%. And importantly, volumes grew 2.2% this quarter. It's actually pretty rare right now to see volume growth in the packaged food space. So McCormick is one of those few companies that is still seeing positive volume growth. And on the bottom line, there was a slight EPS miss, but that was largely due to higher operating expenses. If you look at the gross margin line, that was actually in line with consensus, but operating expenses came a little bit higher, and there was some timing shifts of expenses that was supposed to be in Q2, but it got pulled forward to Q1. So if you adjust some of these things out, it actually was, I think, a pretty solid quarter for McCormick.
Okay, and is that because it's just look, it's a staple is a staple. Is that why that folks are interested in this group right now? If there's uncertainty, people start cooking at home, they're buying stuff for themselves, or what?
Yeah, certainly. Yeah, we're hearing more and more consumers are cooking at home. They're cooking fresh meals at home. They're cooking batch meals at home because it can last longer, like meal prepping, for example. And McCormick is the largest spice manufacturer in the space. And spices and seasonings is a category that's still seeing growth right now in the grocery store. McCormick also competes in other fast-growing categories like condiments. It has Frank's like mustard, for example, and Frank's hot sauce, for example, and Cholula is another hot sauce brand that it owns. And these are pretty fast-growing categories in the grocery store. And then another portion of McCormick's sales it's called Flavor Solutions, and those are ingredients that it sells to other packaged food companies as well as other restaurants and things like that. And that business is also seeing growth as well. And we're pretty optimistic that that Flavor Solutions segment can continue seeing growth. One interesting thing here is that right now with this new trend of eating healthier and removing certain dyes and ingredients in food products, McCormick is actually seeing more activity from its customers, and more of its CPG customers and restaurants want to try to remove some artificial ingredients and things like that. And McCormick could be a beneficiary of that, given it's it's a big supplier to these companies.
All right. Well, you might be talking up the market because it's trying to come back here. It's already up $3, so we're looking at a potentially green candle even after a down start. We do have another staple category in consumer with the Dollar Tree reporting tomorrow. Arun, is there hope for the discounters?
Yeah, no, I think it's a tough environment for them right now in two ways. One, Dollar Tree, which has the Dollar Tree banner as well as the Family Dollar banner. Family Dollar is kind of going through a strategic review right now, trying to figure out what's the future of Family Dollar. And Family Dollar is a bit more exposed to that lower income household who's feeling a bit more pressure right now in this environment. And on top of that, now these dollar stores, Dollar General, Dollar Tree, are facing tariff risks. And these dollar stores are some of the largest importers in the country, and they source a significant amount of their general merchandise goods from China and other countries in Southeast Asia. So we have tariff headwinds, we have tighter consumer spending, and we're projecting a pretty tough 12 months for the dollar store companies.
Okay. All right. Well, a little bit of bounce here last couple of days. We'll see if it raises that bar too high. Then thanks, Arun. Appreciate that.
Thank you.
Tom, you got trades in both, right? Let's start with MKC, which might go green if it rallies about another buck.
Yeah, I didn't realize they had Cholula and Frank's hot sauce. So maybe that's why it's rebounding.
Love those Cholula packets, single packets.
Yeah, it's
still
the best out there.
Into a breakfast item.
I looked at this, it's not a big mover, right? It's a staple. It's rebounding, as you mentioned, over $3 from session lows in this. So I just looked at a paid to wait type strategy here, where if you do want to own the shares, let's sell some calls against it. So I looked at a cover call strategy where for every 100 shares of stock you buy, you sell an out of the money call to the upside. I went out to the April 17th monthly options that expire in 23 days and sold the 80 strike call against your long stock. Now, initially it was about a 76.5 debit for that. So you're buying the shares at a discount, trading closer to 78 right now because the stock has bounced off of those lows. But the debit you pay is also going to be a break even. So by selling that out of the money call to the upside, you're offsetting some of the costs on the stock that you're purchasing, and you still get to collect that dividend, which is about a 2.3% dividend yield on this one. So it's a paid-to-wait strategy. If you think the thing is going to consolidate, you can continue to roll or adjust that short call that you sell against it on a month-to-month basis that collects credits, that reduces your break-even. Paid-to-wait type strategy here if you think that we're at least going to see some consolidation and not much downside.
All right, cover call, MKC. Buy it and hold it.
Yeah.
What about for Dollar Tree? Something more speculative for earnings?
Yeah, I mean, the stock's down nearly 45% from year ago levels. So to Arun's point, I mean, a lot of these Dollar Trees have already gotten beaten up. So anything surprise the upside might, spike it. So I looked at a bullish call diagonal here where you take advantage of that dispersion between implied volatility levels of what you're buying versus what you're selling. So going out to the April 4th weekly options that expire in just 10 days. So really short-term position here, just a tradable position. Buy the 70 strike call. And then in the near term, March 28th, weekly options that expire in just 3 days, sell the 76 strike call. So a bullish $3 or $6 wide call diagonal. You're paying roughly about a $290 debit on it. That's going to be your risk, $290. And you can see here from the risk profile, anything above maybe that 71 level is going to be profitability on this one. But the key here is you're paying less than half the width of this call diagonal, right? It's bullish. You need the stock to go higher. But you're buying basically about 102% implied volatility on aggregate in that April 4th 70 strike call you're buying, and then selling nearly about 165% implied volatility on aggregate in that March 28th weekly, the 76 strike call. So that's why the price or the initial price and risk is contracted on this one.
Okay. All right. So looking for upside Dollar Tree. Okay.
Yeah.
Good luck. Thanks, Tom.
Yes. Yeah. Do the put diagonal if you think it's going to go down.
Sell that instead?
Yeah. It's just it's about the implied volatility levels.
Got it.